Welcome to another episode of Market Brief After Hours. We've got a lot of ground to cover today. It felt like a classic risk-off day on Wall Street, with geopolitical worries taking center stage and putting some real pressure on equities. What is the big picture from today's session?
You're absolutely right. The major theme today was geopolitical anxiety, specifically coming out of the Middle East. That tension pushed oil prices up, which in turn put a lot of pressure on equities. If we look at the major U.S. indices, the S&P 500 fell 0.52% to end at 7,745. The Nasdaq Composite moved 0.32% lower, closing at 26,645. And the Dow Jones Industrial Average shed 273 points, or 0.51%, to close at 53,460. It's a notable shift, especially since the S&P 500 just hit a fresh all-time high last week after a really strong earnings season.
Let's talk about what's driving this. It seems the eyes of the financial world are glued to the Middle East, particularly the relationship between the U.S. and Iran. What happened there today?
The temporary ceasefire, or Memorandum of Understanding, that the U.S. and Iran signed back in June officially expired today. Negotiations to extend it have completely stalled. Iran has ruled out any extension, and a senior Iranian official warned that they would shift to an offensive posture if diplomacy fails, even mentioning readiness to escalate tensions in the Strait of Hormuz. On the other side, President Trump told Fox News that the U.S. would bomb Oman if it gets in the way.
That's incredibly heavy rhetoric, and naturally, energy markets reacted immediately.
Exactly. West Texas Intermediate crude futures jumped 2.6% to settle at $84.50 a barrel, while the international benchmark, Brent crude, rose 2.7% to close at $90.87 a barrel. When oil spikes like this, it brings back all those fears of persistent, sticky inflation.
And we saw that immediate reaction in the bond market too, didn't we? Yields were marching higher.
They certainly were. The 30-year Treasury yield, which is highly sensitive to these kinds of geopolitical shifts and long-term inflation expectations, advanced over 4 basis points to 5.311%. That is its highest level since June 2007, nearly a 2-decade high. Meanwhile, the 10-year Treasury note yield rose to 4.724%, and the 2-year yield, which closely tracks Fed rate decisions, ticked up to 4.182%. It's clear that investors are worried about inflation and government borrowing, especially after last week's report showing the U.S. budget deficit reaching its highest monthly level in over 5 years.
Speaking of inflation, our neighbors to the north are feeling the heat too. Canada's latest inflation numbers just came in.
Yes, Canada's annual inflation rate heated up to 3.3% in July. Economists were actually expecting it to tick up to 2.9% after cooling to 2.8% in June. A big driver there was rising gasoline prices, but interestingly, travel-related costs from the Soccer World Cup also provided a major boost. If you strip out gasoline, the Canadian CPI rose 2.2% for the third straight month.
On the flip side, we did get some surprisingly strong economic data in the U.S., specifically out of New York.
We did. The Empire State Manufacturing Survey showed that factory activity in New York State accelerated sharply in August. The index surged to 20.6, its highest reading in 4 years, completely blowing past the consensus forecast of 12. The new orders index hit 17.3, and shipments were at 11.7, pointing to robust growth in the manufacturing sector despite the broader market worries.
That is a fascinating contrast between strong manufacturing and rising inflation risks. We're going to take a very quick break. Stay with us. Welcome back to Market Brief After Hours. Before the break, we were looking at the U.S. and Canadian markets. Let's turn our attention across the Atlantic now. How did European markets handle the geopolitical heat today?
European markets closed weak today as investors stayed on the sidelines. The Pan-European Stoxx 600 fell 0.22%. Looking at individual countries, the UK's FTSE 100 dropped 0.28%, Germany's DAX closed lower by 0.38%, France's CAC 40 fell 0.66%, and Switzerland's SMI lost 0.61%.
I saw some interesting housing data out of the UK as well. It looks like the property market there is cooling down quite a bit.
Yes, the price of newly listed homes in the UK fell by 2% in August. According to the property website Rightmove, that's the steepest August drop since 2018. The average home price fell to £364,999, which is 1% lower than this time last year. On the equity side in Europe, luxury stocks like LVMH and Kering, the parent company of Gucci, fell 2.7% and 4.3% respectively. However, mining stocks gained as the US dollar slipped, and the Belgian-Dutch drug maker Argenx was a massive standout, surging 17% after its autoimmune drug met its targets in a key clinical study.
Moving further east, Asia presented a pretty mixed picture, especially with some highly anticipated economic data coming out of China. What did we learn about the world's second-largest economy?
China is really experiencing a two-speed economy right now. On one hand, their technological sectors are booming, and exports jumped an incredible 24% in July. But on the other hand, domestic demand is seriously struggling. Retail sales grew just 0.6% year-over-year in July, slowing down from 1% in June. Even worse, property investment plummeted 19% year-over-year, and fixed asset investment fell 6.7% for the January to July period. To top it off, the urban unemployment rate ticked up to 5.2%.
Yet, despite those weak numbers, the Chinese stock markets actually rallied, right?
Surprisingly, yes. The Shanghai Composite Index rallied 1.41% to close at 3982.65, and Hong Kong's Hang Seng Index surged 1.34%. It seems investors are betting that these weak numbers will force Beijing to step up with a major policy stimulus in the second half of the year.
And what about Japan and Australia?
Japan's Nikkei average rose 0.74%, even though their second quarter GDP growth missed forecasts, coming in at an annualized 1.1% due to weak household spending. But what's really catching eyes in Japan is their 10-year government bond yield. It hit a 3-decade high of 2.93% on Monday. Investors are betting on an interest rate hike next month as a weak yen fuels inflation. Down under, Australia's ASX 200 fell 0.46% to a 2-week low, hit by disappointing earnings. National Australia Bank fell 4.6% on slower home loan applications, and electronics retailer JB Hi-Fi plummeted 12.3% after warning of weaker trading ahead. New Zealand's S&P NZX 50 also fell 0.96% on flat services sector data.
Let's pivot to the foreign exchange market. It was a busy day for currency traders, and we have some very specific technical levels to watch. Let's start with the euro against the US dollar.
The Euro-USD pair edged slightly higher, closing up 0.08% at 1.1578. However, it stalled just below its 200-day simple moving average, which sits at 1.1628. The daily candle had a long upper wick, showing that sellers stepped in near the session high of 1.1614. But the short-term trend remains constructive as long as it holds above the 100-day SMA at 1.1568 and the 50-day SMA at 1.1466.
And what about the British pound?
GBP USD consolidated its recent gains, closing up 0.07% at 1.3542. It reached a high of 1.3571 but pulled back, leaving a long upper wick. The structure is still very bullish, trading well above its 50-day SMA at 1.3377, its 100-day SMA at 1.3417, and its 200-day SMA at 1.3414.
The Australian dollar has also been on quite a run lately.
Absolutely. AUD-USD rose 0.31% to close at 0.7104. It formed a very strong bullish candle, decisively clearing its 100-day SMA at 0.7059. It's also well above the 50-day SMA at 0.6990 and the 200-day SMA at 0.6936. This V-shaped recovery looks very strong.
With all this geopolitical uncertainty, it's no surprise that precious metals saw some major buying interest today. Gold and silver both had strong sessions.
Yes, gold surged 0.96% to close at $4,418 an ounce, breaching its 100-day SMA at $4,390. It's well above its 50-day SMA of $4,154, and now buyers are eyeing the 200-day SMA near $4,490. Silver was even stronger, jumping 1.75% to close at $65.84, though it did pull back from a high of $66.55. It's trading comfortably above its 50-day SMA at $61.45, with the 100-day SMA at $68.72 as the next big target.
What about the crypto space? Bitcoin has been forming a very interesting technical pattern lately.
Bitcoin rose 2.4% on Monday to 64.3K, putting it right at the top of a 6-week symmetrical triangle. Ethereum also gained 1.6% to close at $1,906. What's interesting is that this positive price action happened despite investors pulling over $385 million out of U.S. crypto funds last week, largely driven by those escalating Middle East tensions. Investors also seem to completely shrug off a major software hack on Coldcard on July 31st, where over $115 in Bitcoin was stolen, as well as a delay in the Crypto Clarity Act.
Let's wrap things up with some of the biggest individual stock movers of the day. There were some massive double-digit swings out there. Let's start with the biggest decliner.
That would be iPoint, ticker EYPT. Shares collapsed by more than 66% today. The company announced that its experimental treatment for an eye disease failed to meet its primary goal in a late-stage clinical trial. That is a devastating blow for a biotech firm.
On the positive side, semiconductor and tech stocks had a phenomenal day.
Yes, Sandisk led the gainers in both the S&P 500 and Nasdaq 100, closing up more than 8%. Other chip and equipment makers like Western Digital, Applied Materials, and Marvell Technology all gained more than 5%. Micron Technology was also a bright spot, gaining 4% after Commerce Secretary Howard Lutnick stated the administration does not support Apple buying memory chips from China. Plus, reports showed AI startup Anthropic's second quarter revenue surged to over $11.5 billion, which is a massive jump from last year.
Space and defense sectors also had some major news.
Intuitive Machines jumped another 7%, marking its fifth consecutive day of gains. They received an authorization to proceed on a massive $600 million multi-satellite communications program. On the downside, L3 Harris Technologies fell over 4% after announcing that their CEO and chairman, Christopher Kubasik, stepped down effective immediately.
And what about the consumer space? We saw some big moves in airlines and consumer goods.
JetBlue Airways dropped more than 7% after Seaport Research Partners downgraded the stock to neutral from buy. It's been a tough stretch for JetBlue, down 13% over the last 6 months. And Constellation Brands fell over 6% after Berkshire Hathaway announced it had completely liquidated its stake in the company.
That's all for today's episode. If you find this useful, please follow Market Brief After Hours. We'll see you next time.